Hi everyone, this is Koen from Build and Thrive, and today I will talk about the principles of investing. In this video, I will go through the basic principles of investing, how you can start, and what you need to know before you start. I will also share a little bit about my own investment strategy, so stay tuned. So the first thing you need to understand when you start investing is to understand your time frame. Do you need money next year, now, or maybe in 10 or 20 years when you retire? This is very important to understand the difference between if you need to put your money in a normal savings account or if you should invest in the stock market or real estate. In this video, I will talk about long-term investing specifically. So that means that you will need the money in 10 years or longer. I generally focus on long-term gains and not short-term wins. This is called investing, and speculating would be to speculate in the market, try to time the market, read the news and everything to try to have short-term wins. This is not what I'm focusing on. I'm focusing on strategically putting in money and having long-term gains, so build long-term wealth. As they also say in the financial world, time in the market beats timing the market. Fact is, a lot of people, about 80%, lose money when they try to beat the market and time the market. There's never really a perfect moment to start. The best moment to start was a long time ago, but the second best moment is to start now. There might always be a moment where you think, oh, there might be a crisis, or there might be this, or there might be this, or I need to earn money before I can start investing. This is simply not true. You can already start small, and this is also the key to build long-term wealth. The second principle is to understand that investments gain a lot further down the line, so over the years. This means that at the beginning you might not see a lot of returns, but later on you might see growth that is bigger than you can imagine. This is called the compounding effect. Just to give you an example, if you have invested 10,000 euros now and the investment portfolio grows with 10%, then at the end of the year you have 11,000 euros. So you have a growth of 1,000 euros. If you keep on investing each year, then at some point you have maybe 100,000 euros in your portfolio. And then if you have a growth of 10%, then you have 110,000 euros in your portfolio. That means that in 1 year it grew 10,000 euros. Same 10%, just later down the line, because you kept on investing over the years. And 10,000 euros, of course, is much more than 1,000 euros. This is a really nice effect, and it might help you to keep you motivated, even though at the beginning the returns might not be as big as you expect. If you reinvest the profits from year one, every time you get earnings from your portfolio, you will see that your investment portfolio will grow faster and faster. You can see this in this graph. At the beginning, the growth seems to go slower, and then over the years, you will see that the growth goes faster, faster, and faster, especially when you look in absolute terms. Understanding this will really keep you motivated. It doesn't mean you have to be born wealthy to become wealthy in your life. All you need is time, dedication, and patience. When you lose motivation, just think of this graph and the compounding effect to keep you motivated. So I'm still at the beginning of my investment journey, but in this video I can show you a few principles that I use that have so far been proven successful. First, I define my goals. What do I want to achieve with investing? My goal is to reach financial independence. This means that I don't have to work anymore at some point in my life to sustain my living cost. This can also be your goal. Another goal could be to buy a house at some point or to retire earlier. Think about what your goal is and let me know in the comments down below what you want to achieve with investing. So depending on the goal, you can set your time frame. If it's buying a house in a few years, then you would not invest in the stock market, but you would put it in a high yield savings account. You still grow a little bit of your money, but at the same time, you also know that if you would invest in a stock market and there might be a recession, it would mean that you would lose a lot of the value if you need to buy a house, and then you cannot buy a house. So this is good to keep in mind. Then if you have your goal and a time frame, you can define the amount of money you need to put in each month. This is the foundation of your investment strategy. One good question to ask yourself is, what is my risk tolerance? Do I accept if the stock market would go down 50% during a recession? How will I handle this? These are good things to think about and might refine where you want to put your assets. High risks also usually comes with high rewards, and risks can result in losing some money. This is good to understand. There's never a freebie in this world, so be aware that whatever you do, you understand the risks you understand your time frame, and you understand why you do it. So when I invest, I try to reduce my costs as much as possible. You can think of managing fees. Usually the mutual funds that are offered by banks have very high management fees, up to 1.5% sometimes. This can eat away a lot of your profit, so you don't want that. Another cost you can think of, buy-in fees. So your broker can charge you a certain fee in order for you to have access to the stock. What is also good before you start investing is to do some research. What were the previous profits from the stocks or the funds you want to buy? What is the volatility of this product you want to buy? Also look at the general history. For instance, in the 1930s, there was the Great Depression, where stock markets went down. In 2008, there was another recession. Here is also where a lot of stocks went down. Some companies went bankrupt. So before you buy a product, you want to know how it behaves in good times, but also how it behaves in bad times. Historic gains do not guarantee future gains, but it can give an indication of how you might expect it to behave in good and bad times. These are the general principles of investing that you can use to determine what you are going to invest in. There are a lot of different financial products. Just to name a few: stocks, bonds, real estate, mutual funds, ETFs, commodities. It's good to understand each category. Especially before you invest in them, you want to understand how they behave, like the principles I mentioned before. When you invest, also look at the underlying value of the actual thing you're investing in. Try to understand what you're investing in. For instance, if you buy gold, it's very clear what this is. It's a material, so it's easy to understand what it is. The same for real estate. It's very easy to understand that you buy a house. If you don't fully understand what the product entails, then it's very risky. Always try to understand what you buy. A stock, for instance, if you buy a stock from a company, you want to know what that company is doing. You don't just buy a stock because it goes up or down in value. It's more you want to know what it's selling. Does this company you're investing in, is it selling cars? Is it selling food? Is it selling electronics? This is very important to understand, and it can also help you understand how this stock will behave or this company will behave in good and in bad times. Don't put everything in one basket, but spread your risks. You can think of geographical spreading. So for instance, if you live in Europe, you have a job in Europe, and you invest in the North American stock market, then you might spread your risk already a little bit more than, for instance, if you only invest in Europe and you work in Europe. So your income is dependent on the economy of Europe, on both investment side, but also your job side. This also holds for different sectors. If you work in the food industry and you invest in the food industry, then if the food industry goes down, then everything goes down. But if you work in the food industry and you invest in the health and technology industries, then you can kind of spread your risks in this way. So if you lose your job, that doesn't necessarily mean that the stock markets of health and technology industries go down. It just means that the food industry went down. A lot of the times these are correlated. It's good to be critical about these, see the correlation between stocks, between the economy, between your job and the economy, and try to find a balance there and spread your risks. This is quite a difficult thing to do, but it already helps you to be aware and to find if you can find non-correlated products. Another thing I would like to highlight is that there is no general advice that everyone can follow. There are just a few principles that you can use, but in the end it depends on your unique situation, what you need to do in order to reach your goals. So most importantly, you inform yourself and you understand what you're investing in and why you do it. So the last principle I want to explain is dollar cost averaging. Dollar cost averaging means that you put in the same amount of dollars or euros or whatever currency you like to use into the stock market each month. So when you receive your salary, you put a certain amount into the stock market each month in the same products that you always do. Or each month you buy a certain amount of certain companies you like to invest in. This is fixed beforehand, you design this strategy beforehand, and what is nice about this strategy is that there's no need to read the news, because if the stock goes up, you buy a little bit fewer stocks, but if the stock goes down, you buy more stocks, because you put in the same amount each month. And in the end, it all averages out into an average profit or average return. This is quite some information, but this should give you an idea of the general principles of investing. I promise you to share a little bit of my own strategy. Each month I put a fixed amount of euros into two ETFs, namely the S&P 500 and an emerging market ETF, which has spreads from South America and Asia. In this way I spread geographically with my emerging market ETFs, but I also put some of my money in North America and I work in Europe, so in this way I try to spread. It's all spread across different sectors, numbers, so this should also give me an idea to lower my risks. I want to highlight here that it's a relatively simple strategy for me specifically. It doesn't necessarily mean that you should do the same. As I explained in this video, try to understand why you want to invest, what your goals are, and what risk tolerance is good for you. And whatever you do, just be patient, and time in the market beats timing the market. If you like this video, please give it a thumbs up. And if you're not subscribed to my channel yet, just click the big red button down below to get a notification when I upload a new video. See you next time.